Let me bring on board Avinash Godkhindi, who's the Managing Director and CEO at Zaggle and also part of the promoter group. Avinash, it's always wonderful talking to you. Let me first start off by understanding this entire AI play, right? There's just so much pessimism on companies like you as to whether you will be able to evolve in the fast evolving software landscape. Do you believe you can be replaced? How sticky is your product?
Great question. Thank you for having me on the show. And wonderful coverage. I really loved how you covered the company very comprehensively. So kudos to you for that. The one thing we need to highlight here, right? About 2.25% of our revenues come from software or software fees. The rest is all transactions, right? So that's interchange, that's invoice to banks. Even if you take it on a net basis, net revenue basis, about 4.05% of our revenues come from software. So that's point number one on the AI impact. Pure SaaS companies, the story obviously would be different because 100% of the revenue would come from software. In our case, it's 2.25%. So how much disruption could AI bring? You can assess to our business. The other thing, AI actually has turned out to be a big blessing for us. Our customization timelines have gone down dramatically. Our ability to ship code quickly has gone up. A lot of our customers are liking the fact that they are able to not necessarily completely have to redesign all their workflows, but we are able to build capability which sits well with their workflows. So overall, I think if you look at it, the efficiency that it brings internally, as well as the extra ability capability that we are able to offer to our customers, AI has been extremely good. Look, spends have to happen. Companies have to spend money for their employees, for their vendors. And as long as those spends are happening through our ecosystem, we monetize on the spend. Largely, we don't monetize on the software fees in any case, and we never have. So that's something which I think is very important for us to highlight.
I get your point. So your fee, Avinash, explain this to me better. Only 3% of your top line comes from core software recurring revenue.
Correct.
The balance 97 is linked to spending by clients and other individuals within the client base that you have, and therefore you make a percentage of that number. Is that the right way to think of you?
Absolutely right. So the 2.25 or 3%.
Right? Apologies, no, but that is still software, right?
That is actually the spends that you do on the card. So a Visa, MasterCard, RuPay card, and it's interchange, and it's a percentage of that interchange that we take from our partner banks. So the spend in any case will have to happen, whether there's a human on the other side or there's an AI agent on the other side. The company has to spend, and those spends need to come through our platform because the reasons remain the same. We are deeply integrated with the ERP of the corporate. We are integrated with the bank system on the other side. So the reconciliations become much easier, much more automated. So those reasons continue for non-AI world and with an AI world.
Okay, and so yeah, that makes complete sense. So because it's card driven, you also have a physical presence there at your customer base. So there's a physicality to it. Also on top of it, you're so well integrated with ERP that it's difficult to kind of remove you overnight and replace you with an in-house product if someone is building one. That's the right way to think of it, right, Avinash?
Exactly, and we are connected to the ERP on the one side. We are connected to the bank's systems, the card management systems through APIs on the other side. So even if you're able to create a system which connects beautifully with your ERP, the solution for spend management requires both these parties to be connected. And none of the banks would be comfortable to get directly connected to a AI-driven software of the corporate because they are not going to be able to audit the corporate. Today, all our 19 partner banks audit us. They enforce their security standards on us. They wouldn't be able to do that with partner customers, right? So there is a requirement of an intermediary, and that intermediary in this case is Zaggle, which brings all these pieces together. Companies also work with multiple banks. So if they were to try and integrate with multiple banks, that becomes that much more complicated.
Okay, yeah, I get your point. Now, talk to us about AI. So you're saying that there is going to be a shrinkage in terms of your time or your employees' time spent on coding, right?
Yes.
Does that therefore mean that your EBITDA margins expand quicker than what you were earlier anticipating? Does it mean that you're able to churn out more product? What does it mean? Give us a sense of that.
Yeah. So I'll give you hard data, right? So today, the last analyst call and investor deck, we shared that the number of employees that we have is 325, down from a number of about 400 a few quarters ago, right? So you're seeing that we are able to generate a lot more revenue with a much smaller base of employees. And why is that? It's purely AI or largely AI. AI is allowing us to be able to, ship a lot more at a lot lesser time, it with much greater efficiency, right? So that's the clear impact with data and facts that we are seeing on our business.
Okay. And talk to us, therefore, about what this does to your margins. You've guided for a 15% EBITDA margin in the next 5 to 7 years. You're currently at 10. You've cut down, obviously, on employee costs. Give us a sense whether margins, therefore, go up more dramatically going forward. Because, I mean, the last 8 months was just the trailer. The movie is actually about to start where AI is concerned. And therefore, the impact of that on your P&L, give us a sense. Does it give you confidence to drive up EBITDA margin to 15% in, say, 3 years instead of 5?
See, the acceleration is likely to happen in terms of EBITDA at a much faster pace than what we had originally anticipated. The other place where we see AI helping us a lot is our pricing power goes up, because if a company wants to deploy an AI solution, what are their options? Are they going to build a full-fledged in-house AI team to be able to develop all this? 9 out of 10 companies won't be able to do that, right? So there are a lot of capabilities, especially on the FinOps side, that we are building, which are state of the art, spectacular, not just from an Indian perspective, from a global perspective, and that allows us to be able to charge a much higher premium as well. So there's the benefit on the cost side. Two, there is the benefit that we hope to see in the coming years on the margin expansion for revenue side. So all in all, it's we are extremely bullish and chuffed about the impact of AI in our space. And the stickiness, as I mentioned previously, comes from our position where we are a many-to-many connector, many corporates on the one side, many banks on the other side, and we sitting as a intermediary there.
Understood. And an irreplaceable intermediary, right? Is that how you would term yourself, Avinash?
Absolutely.
Okay.
Absolutely.
Okay. So that gives us good clarity. Okay. Give us also a sense with regard to your revenue growth trajectory. You've done nearly 50% growth over the last few years. You've done, in fact, 52% last 3 years. And that kind of growth clip continues. But for how long? You've guided for $1 billion revenue, rupee revenue by FY, maybe in the next 5 to 7 years. Do you advance that given AI and given that your product suite will be much wider, much faster now?
See, it's possible. We've said $1 billion, assuming that rupee doesn't go completely, off the charts. So if you look at it safely, say a 9,000 crore kind of number by FY32. Right now, we are sticking to that, but as we see in the next couple of years, the trajectory and the positive impact of AI, we could accelerate that, and that's a definite possibility. Growth obviously comes to us, A, organic, domestic, B, inorganic through the acquisitions, which some of them are doing wonderfully well, like GreenEdge and Mobileware, which is an investment, and of course, potential entry into international markets. So there are many levers for growth. And look, today we've just scratched the surface in terms of the opportunity on spend management in India, even though we are a market leader. 30 years ago, ERPs were unknown. 20 years ago, HRMS was unknown. 10 years ago, CRM was unknown. Those are established categories today. In 10 years' time, we strongly believe in India, we will be the market leader, and spend management would be a very well understood category by investors and CFOs. So that's a prime position that we hold today, and we want to be able to take full advantage of that in the coming years.
Right. Avinash, plenty of questions on your cash flow from operations, some of them coming from me. And that'll bring a smile to your face because you'll recall all those questions. But Avinash, tell me, in terms of FY27, your EBITDA will roughly be 200 to 20 crore odd. If I've done the math right, at you growing at a 40 to 50% kind of clip. So you'll do roughly 220 to 230 crore of EBITDA. How much of that converts to cash?
The EBITDA could be higher depending on what the top line is, because this year itself we would be, in a 180 sort of range potentially, right? But a lot of it should convert. Of course, it's a journey. Improving cash flows is not something which is a one-shot activity, and we've been working behind the scenes very diligently on that. Look, the broader perspective that we want to share with the market is we were always cash flow positive until our IPO or thereabouts. We raised capital to grow, and we've deployed that capital in the business for growth, right? That's growth is obviously visible to all, and the next step is to improve the cash flows, and we are committed to that, and we hope to see much better cash flow numbers and EBITDA to cash flow conversion in the coming years.
I'll call that non-committal, Avinash. Of course, EBITDA will improve, but you're not giving me a number on the cash flow. Okay. Now give me a sense, Avinash. You've got 500 crore odd of cash that you sit on. You're a 3,000 crore market cap company. You're obviously doing acquisitions, but you're doing smaller acquisitions. What are you going to do with all this cash? And now you're cash flow positive. You're going to do 100 crore plus of cash flow eventually, likely. What do you do with all this cash?
No, of course, we want to deploy that cash to be able to make smarter, better acquisitions, larger acquisitions, both domestically, globally. But the one thing we are committed to is compliance. So acquire companies where the cap table and the compliances are clean and correct. The other, of course, we want to enter into companies where the valuations are reasonable, because it's all great to acquire a company at a very steep valuation, but how do you make sure you're generating returns out of that? So it's taking a little while for us, but we are working diligently. Some of the smaller ones have generated extraordinary returns for us already, like a Green Edge, where we acquired the company for up to 20 crores. We paid 12, and the company is already doing this year revenues around 70 plus crores at an EBITDA of about 7-8 crores. So that's the kind of results that we are seeing. The one or two larger ones that we are exploring, but don't want to talk about them until they close.
Okay, Avinash, we will call you though, and we will have a conversation with you when those close. Completely out of time, unfortunately. This conversation could go on, but viewers, completely out of time. Thank you so much, Avinash, for coming and speaking with us, giving us that perspective.